Hi, good evening. A very warm welcome to all of you for the Kotak's monthly market outlook for the month of May 2023. Uh, I am Devendra Singhal and I'm an equity fund manager with the Kotak Group. Talking about the global economy, the first thing which comes to our mind is the number on the inflation. We have all seen the numbers coming down, albeit it's falling more slowly than anticipated. If you look at the April 2023 World Economic Outlook, the numbers on the growth are almost steady with a little less volatility than was earlier projected. But the numbers on the projected inflation path are a bit higher than what was being looked at in January 2023. As a result, Avinash, if you can go to the next slide, we have seen that many central bankers are taking a pause and wanting to review the policy decision before they take step ahead. In fact, if you look at the heightened portion, these are the ones where the policy rates have been hiked in the month of March. All the other ones has been basically taking a pause. As per the last numbers by the US, the Fed, they have taken a hike, but the commentary seems to be that they're ready to take a pause going forward. Now, the question which comes to our mind is the world facing recession? Well, if we look at the probabilities that the countries across the globe facing recession, we see that most of the big ones, likes of UK, New Zealand, USA, Germany, Italy, and Canada, have almost 60% plus probability. Hi, am I audible?
Yes, you're audible.
Yeah, okay. So they have a more than 60 to 70% probability of the economies going into a recession. Well, we are in a sweet spot with the probability assigned to India going into recession being practically zero. Avinash, next slide, please. Now, the developed world has a loose monetary policy. A benchmark for the interest rates globally has been the real interest rates, which is basically the savings interest rates minus the inflation. We have seen that the advanced economy or the advanced economies are generally having now a negative inflation rate. The emerging economies are faring a bit better, but definitely there's a lot more inflation in the advanced economies, which is taking the real rates interest down. One important parameter which we look at in terms of equity market is the global equity risk premium, which is definitely, as per the data being shown, is below the long-term averages, and it's almost at more than a one standard deviation their number therein. So as long as the equity risk premium is lower, the incentive to be in the equity markets keeps reduced, and to be in the debt side is on a higher side. Next slide, please. So, and this is also visible in most of the investors being underweight stocks versus bond since 2009. This is one of the most underweight positions we have seen since 2009. And as can be seen, barring the Jan 22 period when the market had a very sharp rally post-COVID, today we are sitting at one of the most underweight position in the stock market versus the bonds. Rightly so, because bonds are also giving you a pretty handsome yields at this point in time. Let's talk about the US economy. The biggest number which is being there is the US CPI inflation, which has eased a bit, but the core inflation still remains sticky. These are the numbers which is being there. And you can see that the Fed is trying hard to maintain the balance between the two. The current rate hike has been the steepest which we have seen in terms of the number of hikes since the first increase has happened. If you can see on the left-hand side chart, the current rate at around 5.5 is almost highest and the steepest we have ever seen in the history of US market. The Fed has tried its best to basically withdraw the excess liquidity, but that has been very low considering the amount of money which they have pushed into the market and the amount of money which they have so far been taken out. So versus a $4.8 trillion infusion which they have done over the last few years, the total money which has been withdrawn is a paltry $400 billion. So we still have a long way to go to be there. Now, the biggest question is, will inflation come down sharply? Well, we have seen that this chart gives you how far are we from the in terms of the months from the peak inflation to come down, and we can see that it looks like there's a long road ahead. Historically, we have seen that the Fed tightening cycles always break something. In 70s, it was the Penn Central Bank. In 74, it was the Franklin National Bank. Then we have seen the LATAM debt. 87 market led to a stock market crash. We have all heard about the long-term capital management LTCM bubble, and then was the tech bubble. The 2007 led to the subprime crisis, and currently also we are seeing that few of the smaller banks are basically going belly up. So 2023 is a standout year for big collapses. If you look at the total assets, it's basically on a higher side, and the number of bank failures so far it's been slow, but with the way the things have been going up, I think you may see a few more casualties before we basically see sanity in the market going forward. Public pessimism on the economy hits a new high, and the Americans are extremely pessimistic about the economy. And we had earlier seen that the probability being assigned to them falling into a recession is almost 60%. Now, this is also one of the reasons the bulls are basically talking that the Fed may take a U-turn on the policy rate sooner than what is being envisaged. Well, only time will tell what's the way forward there. One thing with the Fed is really worried about is the US labor market, which remains at its tightest level in decades. There are more there are more jobs than the number of applicants which is being there, and the situation is still holding true. The labor rate market is really tight, and the wage rates as a result are on a firmer side. The manufacturing activity, though is still high, is contracting, which is what the Fed has been wanting. So yes, the rates hikes are working, but albeit at a slower pace. Now, if we look at the earning per share leads in the last quarter, the profit growth has disappointed, while the revenue growths have remained resilient as per the numbers which have been declared by S&P 500 companies in the last quarter. So clearly, you are seeing that the margin pressures, both in terms of wage hikes as and in terms of commodity pressures, are being through on the corporate profitability. Well, a weaker US dollar means that the emerging stocks outperform developed market stocks. We have seen in the past, and it's a good news for markets like us, that if the dollar remains strong, weak, then we have a better opportunity to outperform, and the money would start flowing to emerging markets going ahead. Well, talking about Indian economy, it is definitely the oasis in the desert. If we look at the headlines in the month of April, we saw that the Q4 investments hit an all-time high of 14.6 lakh crores. Our manufacturing PMI hit a 4-month high on robust demand for new orders. The service PMI jumped to 62, reaching a 13-year high in April 23. WPI inflation eases to 9-month low of 1.34. Apple India's output soared to $7 billion as production starts shifting from China. The rail traffic data hits a high, and it shows for a 20% drop in the suburban transport and a 29% drop in non-suburban transport compared to 2019-20. FMCG, on the other hand, shows no signs of recovery in rural demand, and there has been a muted volume growth on cars in Q4. So while we are seeing some positive, but there are also negatives also. GST collections is something we all need to cheer about. The trend in the GST collection continues its upward trend, and we saw a record number of 1.87 lakhs crore in the month of April 23. Fresh investments are also reaching a record high, with the numbers both being projected in FY23 in lakhs crore, along with the government and private, are likely to hit a new peak going forward. We are all looking at the housing data, and as per some experts, we are in the starting of an uptrend cycle in housing. there have been some projections which says that housing can grow in double digits over the next 5 years. Well, is it so? Let's see. India's services exports has surpassed the pandemic era imports era high, and we are seeing that the October-December data had a high of 9.9% as a percentage of GDP. On a similar side, we are seeing a manufacturing exports also hitting a high, which is basically giving some cushions to the current account deficits going forward. So these concerns about the trade deficits are now easing, and hopefully with the next slide, please. With crude behaving the way it is, we should be in a comfortable position going forward. One good thing which is there in the current system is that banking, the key backbone for the Indian economy and the corporate India, the banks' balance sheets are very, very healthy, and banks are well capitalized, both in terms of the CRR ratio and the Tier 1 capital ratio. These are at a very, very strong level across the board. So we are definitely in a much better position to see that the credit growth which is getting revived can continue for some more time before the bank starts raising further capital going forward. Sorry. One worry or the conflicting signs which comes up is on the monsoon side. Will monsoons be average or will monsoons be deficient? Well, there have been two nodal agencies. One is the government, one is the private side. The IMD and the SkyMet. If you look at the middle two rows, which is the below normal, then one is predicting a 64% probability of the monsoon being below and normal. Another is predicting a 65%. So looks like there are more chances of a normalized, slight below normal monsoon going forward than what is being there. But if it's around 95% and above, we are in a good state. El Nino risks are rising. SOI is currently in neutral zone and pointing towards the occurrence of El Nino, which has traditionally resulted in a deficient monsoon rainfall therein. The good news has been agriculture has been a growth savior so far, but what will be the adverse impact of El Nino? Where if you look at this data, you would see that over the last 6 years, agri gross value add has been basically on a positive side, and it has been contributing to the overall economic growth. With El Nino, is it going to impact? Let's find out. Well, El Nino does have some impact on the GDP, but not much on inflation. If you can see the left-hand chart, the top left-hand chart, you would see that the weak monsoon years do see that the agri GDP growth rate declined by 3 percentage points, but the food production decline has only been around 3% versus 2% therein. So on versus an average growth. So it has a limited impact on CPI inflation, though there is some impact on the GDP growth for sure. On the other side, this is also a very important slide to look at, which says that the rural economy is only partly agri. You would be surprised that despite the noise around that rural is basically agriculture, only 40% of the rural economy is now agriculture. The last few years, there's been a lot of push on the rural infra development, which has led to soften the agri growth in the bad years. So if you look at the top right chart, you would see the total roads being built under the PM Rural Roads Program, and the cumulative kilometers being built is on a high. In fact, there's also been a steady gain in made in irrigation facilities being there. So versus 2004, where we have only 41% of the area being under irrigation, we have in FY19, where the last data being available, we have seen that improve to 51%. So the dependence on monsoon is receding, but it's still important. Well, oil prices have corrected almost 38% from the peak in March 22, and we have seen them decline by another 6-7% in the recent days. Well, I think we should all be thankful for that, because India, as we all know, is a very large crude importer. and a lower price here is definitely a good signal for the economy to go forward. However, as discussed in our previous slide, consumption spends remain subdued. We are still below the pre-pandemic level trends, both in terms of the urban market as well as while urban market growths are basically muted, rural market definitely is showing negative growth for now. While the deceleration in growth is reducing, we are still not back into the positive territory on that count for sure. Some of the data points towards subdued consumption is basically if you look at the two-wheeler sales versus the four-wheeler sales, you would see that we are far behind what the peak sales has been on two-wheelers. So if you look at the data, 21.8 million two-wheelers is what we consumed in 2019. And if you look at the last year, it was almost around 13.5 million, which is a very, very sharp fall, which we have seen. Cement monthly productions are just basically averaging on 4.7% there. The 3-year CAGR in terms of petroleum product consumption is still below the pre-2020 levels, and so has been the monthly electricity consumption. Next slide, please. Well, if you look at the UPI data, we are seeing an uptrend here. There has been some uptick in the credit card spends. On the other side, the debit card spends has been on a receding thing. The wallets are definitely seeing a slowdown there. If you look at the railways non-suburban passenger booked in April, Feb, you would definitely see a decline which has been there across the regions there. So you are seeing mixed signal, but on the other side, poverty in India has significantly reduced. If you look at this slide, you would see that from 2016 versus 124 million households which were categorized as poor, extremely poor, today that number stands at around 15 million or so. Well, coming down to the equity markets, India is seeing positive FPI flows in March and April 23, which is a good sign because that has been one part of the market which we have been missing so far. Next slide, please. The strategic long-term allocators have low India allocations. So if you look at the sovereign funds and the government-owned entities, the investments in Indian equity markets has been only around 74 billion, whereas the total investable assets is around $10 trillion. So the approximate allocation in the Indian market is apparently 1% therein. Whereas if you look at the same data in terms of pension funds and endowment funds, the data is even more less, and you are only looking at a 0.1 and a 0.5% allocations to India. So we have a long way to move forward on this and a huge scope for the FPI flows to come in. The equity valuations are at a fair value. We have been averaging around 18.4x 1 year forward numbers, and we are just about there in terms of Nifty forward earnings. In terms of the Nifty price to book, we are at a 1 year number of 2.9. The average has been around 2.6. So definitely what was there a few quarters back, we have seen the equity valuations being at a reasonable side therein. If one look at the long-term averages and the difference between the bond yield and the equity earnings yields, that is also basically now coming at a low of around average of around 158 bips. And one number which we always keep talking by the FII is that the India's premium to the emerging markets, which has actually gone up almost close to 100%, it is now back to on long-term averages of 48% therein. So we are basically just being there. In terms of the market cap to the GDP ratio, we have seen the market cap decline as a percentage of GDP to around 95%. Average has been 80%, but the composition of the market has also improved in favor of services. Versus a peak of 112, we are at a reasonable 95. Well, still some way to catch in terms of the valuation, but definitely much better than what we were a year back. If we talk in terms of the results which have been there so far, we are seeing the Q4 numbers coming out. Well, if we talk about the Nifty numbers, almost 21 companies have posted the numbers so far. and of that 16 has resulted in line numbers in terms of revenue, but the margins have declined for those for more companies than what was expected. So EBITDA and profitability has been on a subdued level. Revenue wise, we have broadly been there and we have been in line. Same number, if you look at the Sensex, there mostly the numbers have broadly been in line, and but the margins has something to cover up in the coming quarters. Well, in terms of the EPS estimates, they have been broadly stable. So if you see the numbers for 2024 and 25, there has not been much change as we have moved into from the months therein. Thanks to all of your support, DIIs have been becoming a dominant player in the equity markets. If you see the few periods, the FI versus the DII equity flows, we are seeing basically a multiple times of FI flow being put in by the DIIs. And we have been able to absorb a lot of flows from the FIIs when it comes to the selling. Having said that, we would say that be ready for the volatility. The key events to watch out for on the global side are the US recession, Russia-Ukraine war, the Fed pivot, as in when the Fed pivots there, and energy prices. All these are very, very four important indicators on the global side to watch for its impact on the Indian markets. Whereas on the domestic side, the similar can be said in terms of the RBI pivot as to when they basically start reducing the rates, the corporate earnings, because the markets are a slave of earnings, so there cannot be any disappointments there. And one big event which would come in 2014, which is the general elections, and a lot many state elections preceding that. So brace for volatility going forward. Well, if you look at the markets, they made a high of 18,161 in October 21, and post that it's almost 6 quarters which is being there. The forward P, which was around 26.2, has gone down to now 19.2, which is a result of the earnings which is moved from 693 to 940. So while the earnings have grown, the market hasn't. As a result, the valuations are becoming attractive as we go forward. So what we recommend to you is that we continue with a neutral way to equities, but with a buy on dips. Any decline should be taken as an opportunity to increase allocation to equities. When we talk SIP or STP with a long-term view, that is the way forward. Next slide, please. So one has to be patient in the market and keep disciplined investing for a long time. The god of the market, Berkshire Hathaway, the Warren Buffett, even he hasn't performed consistently over period. There has been a long periods where he has also underperformed the market. And this is basically the 10-year alpha of Berkshire Hathaway or S&P 500 TR. So there would be some periods of underperformance. There could be a larger periods of underperformance, but we have seen that equity markets outperform any other asset class over longer runs. So keep the patience, keep the faith therein. And at Kotak, we are proud that we have been able to add value to the investors via systematic investment plan route. If you look at our returns and the alpha, which has been there for almost all the funds which have been there, we have consistently added alpha since inception and on a 3, 5 year, 7 year basis across the board. So these, yeah. So even on the absolute return basis, somebody who was basically coming up with lump sum investments, barring a couple of funds, apart from that, we have been consistently adding alpha to all the funds across and over all year periods. Next slide, please. Next slide, please. So if you look at these few funds, which are there on the screen, and which are the few of them are even recent launches, we have added value in terms of the SIP in there also. Flagships, flexi cap, tax saver, there has also been adding value. And even on the hybrid schemes, we have been able to add a lot of value therein, as can be seen from the alpha which we have on our equity hybrid, balance advantage, and multi-asset allocator fund therein. Well, many of you have asked in the last few quarters about the flagship FlexiCap fund. And well, we do agree that this fund had a weak performance period, whereby we were not able to generate alpha over that period. However, we have come up pretty sharply here. And as you can see, that the last 6 month and 1 year alpha in this fund has been pretty strong. And it has more than made up for the fund's underperformance over the last 3 years. And we are now having an alpha of across the board barring this 3 year period since inception. We do hope that this performance would continue, and this shows that the size is not an issue when it comes to alpha generation therein. One of the newest offering which we had, which came out with an NFO in September 21, the Kotak Multi-Cap Fund, a Triveni Sangam of large caps, stability, mid caps returns, and small caps opportunities there. This fund, since inception, has given a return of 5% and has given an alpha of 3% over the benchmark. On a last 1 year basis, the fund's return has been 12% with an alpha of 8% therein. I would request my colleague Deepak to take over and share some slides on the debt side. Deepak, over to you.
Hello, everyone. Last year, global central banks have been reducing their balance sheet, and it is expected that the reduction in balance sheet will continue over the course of next 1 to 2 years. So central bankers globally are expected to reduce liquidity to the tune of $1 trillion. Similarly, over the course of last 1 year, across the world, central bankers have raised rates. Fed has raised rates by 500 basis points. Now Fed has likely reached the peak, and the expectation going ahead is the Fed is likely to cut rates. So even in, let's say, ECB and Bank of England are expected to hike rates by 25 to 50 basis points over the next 3 months. But post that, the trajectory of global interest rate is likely to be lower. In US, markets are expecting Fed to start cutting rates from September 23 onwards, and a cumulative rate cut to the tune of 200 basis points over the course of next 2 years. Now this time, post this hike, the core CPI inflation in US is close to 5%. Post the Fed hike this week, the US Fed fund rate is in the band of 5.25. Now for the first time over last 1 year, the Fed fund rate is higher than the inflation rate in US by close to 10-20 basis points. And at current juncture, we have a positive real rate in US. Again, basically, finally, what should decide the currency movement? In 2013, we saw a huge depreciation in Indian currency because at that time, our real rates were lower than the real rates in US. This year, where US has raised rates by 500 basis points and India has raised rates by 250 basis points, initially we saw a depreciation, but post that for last 3 to 6 months, our currency has stabilized. Even after the hikes, currently, the real rate in US is close to 0.2, 0.3%, and the real rate in India, based on the last inflation number of 570, the real rate in India is close to 80-90 basis points. Since the real rate in India is higher than the real rate in US, it should continue to support the currency, and we expect currency to remain in a range bound. Again, RBI's monetary policy is decided based on forward-looking inflation. RBI has projected FY24 inflation at 5.2%. So at 6.5%, that is a real rate of close to 1.3%. We believe that RBI probably is done with its rate hikes and it will be in long pause. We don't expect RBI to cut rates before calendar year 2024. Yes, there are some risks to inflation. Probably currently, yes, crude oil prices have been volatile, have been trading in the band of $75 to $85 per barrel. However, if OPEC continues to cut output, there's a risk that crude oil prices can jump up, which could lead to higher inflation numbers than RBI estimate. Plus, at the same time, there is risk of El Nino during the current year, which could also result in slightly higher inflation. But if the inflation is in the band of 5/4 to 5.5, with a positive real rates close to 100 basis point, and the fact that global central banks have turned, we believe that RBI is also done with its rate hike, and we are in long pause, and any cuts are only in calendar year 2024. Liquidity, which was close to 6 to 7 lakh crore in the let's say April 2022, now is down to close to 50,000 crore only. So liquidity from huge surplus has now come down to close to neutral levels. And during the current year, RBI will have to add liquidity into the system in order to ensure that deposits grow and take care of the credit needs of the economy. During the year, RBI may add liquidity either by building up its forex reserves. So we expect, so the market estimate is RBI will have to infuse close to 4 lakh crore liquidity during financial year FY24. Out of that, 50% we believe will happen through increase in forex, and we expect RBI to do OMOs and resort to CRR cut in order to infuse residual 2 lakh crore into the system. The yield curve continues to remain flat. 1 year cost of borrowing is 7%, 5-year cost of borrowing is 5%, 10-year cost of borrowing is 10%. So the yield curve is practically flat in India. We believe that the yield curve will continue to remain flat during the calendar 2023 or might invert. Today, a 5-year GSEC is trading below a 1-year T-bill. And post the rate cuts, which we expect next year, the yield curve is likely to steepen. Given this view, we believe that 3 to 7 year is a good segment to stay invested. Among the debt schemes, among our multiple schemes, and post the changes in taxes, we still believe there is merit for investors, distributors to advise debt funds to their investors because of easy liquidity option. Liquidity can be generated at short notice. The funds are professionally managed. When an investor is buying a debt fund, he is owning a diversified portfolio. And plus the fact that in case of debt funds, you pay tax not based on your accrual, but you pay tax only when you redeem from the fund. Our calculations suggest that for an investor who stays invested in a debt fund for a period of 5 year or 10 year, the post-tax return due to the difference in timing of paying tax is close to 40 to 50 basis points. So that's a good. So let's say if other traditional options and debt mutual funds have similar portfolio yield, then due to tax effect, a debt fund post-tax return could be 40 to 50 basis point higher. Plus a case in point, currently our banks are strong, but let's say we have seen spate of banks failing in US. If a particular investor in India invests in a bank, if a bank goes down, the amount which is insured is only 5 lakh rupees. Whereas when you invest in a debt portfolio, the portfolio is diversified, so your entire money is safe. So that principle should also be kept in mind, that if a bank goes down, your only 5 lakh rupees is insured. That also makes a strong case for continuing allocation in fixed income products. Then in the current environment, we are advising dynamic bond fund. We believe that interest rates are likely to go down starting next year over the course of next 18 months. Dynamic fund where the duration of the fund is actively managed is an appropriate fund at the current juncture. The fund has generated alpha over the course of last 1 year, 2 year, 3 year, 5 year period. And this is a very suitable product for investors given the interest rate environment. Post the tax changes, hybrid funds become even more attractive on a post-tax return. We have Kotak hybrid scheme where the equity allocation for the investor is between 15 to 25%. The average equity holding in our hybrid scheme since inception has been close to 22%, and the current equity allocation is close to 25%. So here an investor is taking a marginal equity risk, our upside downside ratio is close to 4 times. So when the market rallies, our upside is close to 41%. We capture 41% of the rally. And when the market falls, we are down, the downside ratio is only 10%. So here the upside downside ratio is close to 4 times. Again, a good product which can be sold to investors post the tax changes. It has only a 22% exposure to equity on an average. Again, an equity saving scheme where the equity exposure on an average since inception has been close to 29%, and the current equity exposure is close to 35%. There also the upside downside ratio is close to 4 times. In addition, we have two schemes, which is Kotak Multi FOF, where the upside downside ratio is close to 2 times, and the average equity exposure since inception has been close to 47%. At the same time, Balance Advantage Fund, the average equity exposure has been close to 42%, and the upside downside ratio captured by the fund is close to 2 times. Again, let's say if we look at Kotak Equity Saving Fund, this fund enjoys the equity taxation where the minimum equity allocation has to be 65%. So when the fund manager is relatively bearish, then he increases the arbitrage allocation in order to ensure 65% equity is maintained. And when he is bullish, probably he'll increase the cash allocation in the fund. This fund is a suitable alternative to debt products, where let's say if we keep 7% threshold, then the number of times the fund over a period of 3 years. So let's say on a rolling return basis, if a customer stays in this fund for a period of 3 years, 88% of the time the fund has generated a return of close in excess of 7%, which might be a threshold which an investor is looking from a debt fund. If an investor has stayed in this fund for a period of 3 years or 2 years, 100% of the time the fund has generated positive return in spite of an allocation to equity. So this is a fantastic product where post changes in debt taxation, investors, distributors can sell these products to their clients, advise these products to their clients as an alternative to fixed income products. Again, debt hybrid scheme with our average equity exposure has been close to 22%. Current exposure is close to 25%. Yes, the taxation is similar to debt, but over the course of last 3 years, it has generated an alpha of close to 5%. So this fund has the ability to generate excess alpha, which will take care that the post-tax return from this fund is relatively higher as compared to any other debt product. So we believe post the changes in taxation, hybrid funds are a very good alternative as compared to debt funds for your investors. Again, since March 2020, we have been advising allocation to gold, and it has delivered fantastic returns since March 2020 till date. The CAGR return, the absolute return is close to 36%, and which translates into a CAGR return of close to 11.5%, 12%. We continue to advise investors to have an allocation to gold. Last year, what helped gold was the central bank buying gold. Last year, central bank across the world have bought gold to the tune of 1,000 ton. Basically, last year when the Russia-Ukraine war broke out, Russian central bank assets were frozen. So I think post that also our view was that central bankers across the world would like to diversify their forex reserve and might increase its allocation towards gold. Again, there is a study that whenever Fed pivots over next 6 months, gold is the best asset class performing. In fact, it has outperformed S&P 500 as well. Today also we are at a juncture where Fed has more or less pivot in this policy, and it was not an explicit pivot but an implicit pivot. Fed is likely to pivot in June or September policy, and therefore we expect gold to continue to perform over the course of next 3 to 6 months. Again, there are risks to investing in gold. Currently, there is close to 15% duty being levied in India. So whenever this reduction in duty happens, we could see drop in gold prices in rupee terms for the customer. So this should be kept in mind while allocating investment in gold for your investors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.